studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that Sunky died.
In the previous section, we learned that non-calendar year ends can create significant challenges when reporting investment income. That naturally leads to an important question. If most investment reporting documents are prepared on a calendar year basis, why not simply align the corporation's fiscal year with those documents? This is exactly why many investment corporations choose a December 31st year-end. On the left side of the slide, we can see the ideal situation. The corporation's fiscal year runs from January 1st to December 31st. The T3 slips cover January 1st to December 31st. The T5 slips cover January 1st to December 31st. Brokerage tax reports and annual investment summaries are also prepared for the same period. Everything aligns naturally. Because all of the reporting periods match, the accountant can reconcile information more easily. Bookkeeping becomes simpler, and tax reporting becomes much more efficient. This alignment often leads to lower accounting costs, fewer adjustments, better accuracy, and less risk of reporting errors. Preparing the T2 corporate tax return also becomes significantly easier because the supporting tax documents correspond directly to the corporation's taxation year. Now compare that to the situation on the right side of the slide. Suppose the corporation uses a March 31st year-end. The corporation reports income from April 1st to March 31st. However, the T3 and T5 slips still report information from January 1st to December 31st. Immediately, timing differences appear. Some income belongs to one fiscal year, while other income belongs to a different fiscal year. The accountant must perform allocations, accrual calculations, reconciliations, and additional analysis just to determine which amounts belong in the current taxation year. As the investment portfolio grows, these adjustments become more time-consuming and more important. This additional complexity often results in more working papers, more professional judgment, higher accounting fees, and a greater risk of errors. At the bottom of the slide is the key idea. Most investment reporting documents are built around the calendar year. Because of that, a December 31st corporate year-end creates natural alignment between the corporation's records and the information provided by financial institutions. For many investment corporations, especially those that primarily earn passive investment income, a December 31st year-end can be one of the simplest ways to improve reporting accuracy and reduce administrative complexity. The key takeaway is this: when investment reporting documents and the corporation's fiscal year follow the same reporting period, life becomes much easier for both the accountant and the corporation. At this point, we know that a December 31st year-end can make investment income reporting much easier. But that does not automatically mean every corporation should change its year-end. The real question is, when does a year-end change actually make sense? Let's start with the situation where changing the year-end is often a good idea. On the left side of the slide, we have a common scenario. A corporation originally operated an active business and adopted a year-end, such as March 31st for business reasons. Years later, the owners retire. The active business operations end. The corporation now functions primarily as an investment holding company. Its activities consist mainly of earning interest, dividends, capital gains, and other forms of passive investment income. However, the corporation continues using the same March 31st year-end that was established years ago. In situations like this, it may be worth asking whether that original year-end still serves a useful purpose. If most of the corporation's activities now involve investments, and most of its reporting documents arrive on a calendar year basis, a December 31st year-end may be a much more practical choice. This is especially true when the corporation receives multiple T3 slips, T5 slips, brokerage reports, and annual investment summaries. The larger the investment portfolio becomes, the greater the potential benefits of simplifying the reporting process. However, the right side of the slide reminds us that changing the year-end is not always the correct decision. Some corporations are part of a larger corporate group. For example, a holding company may own shares of an operating company, and both corporations may intentionally use the same year-end. There may be important reasons for maintaining that structure. The current year-end may support tax planning strategies, group reporting requirements, financing arrangements, management reporting systems, or other business objectives. In these cases, changing the year-end could create new complications instead of solving existing ones. That is why professional judgment is so important. Before changing a year-end, an accountant should always ask a simple but critical question. Why was the current year-end chosen in the first place? Understanding the original purpose often provides valuable insight into whether the year-end should remain unchanged or whether a new year-end would be more beneficial. The checklist at the bottom of the slide highlights some common indicators that a change may be worth considering. The corporation primarily earns investment income. The active business has ended. The corporation receives numerous T3 and T5 slips. The investment portfolio is significant, and management wants a simpler and more efficient compliance process. The key takeaway from this slide is that a December 31st year-end can provide significant benefits for many investment corporations, but the decision should never be automatic. Before making any change, always understand why the existing year-end was chosen and evaluate whether those reasons still apply today. So far, we've seen why a December 31st year-end can simplify investment income reporting, and we've discussed the types of corporations that may benefit from making the change. The next question is, how does a corporation actually approach this decision? The process begins with a review of the corporation's current situation. Before making any changes, the accountant should understand the nature of the corporation's activities. Is it primarily an active business? Is it now functioning mainly as an investment holding company? Are there associated corporations, financing arrangements, or reporting requirements that could be affected by a year-end change? Once the current situation is understood, the benefits of a December 31st year-end can be evaluated. For many investment corporations, the advantages are straightforward. Investment reporting documents, such as T3 slips, T5 slips, brokerage tax summaries, and mutual fund reporting packages are typically prepared on a calendar year basis. Aligning the corporation's fiscal year with those documents can significantly reduce reconciliation work and improve reporting efficiency. If a change appears beneficial, the next step is preparing a reasonable business justification. The objective is to explain why the proposed year-end is more appropriate for the corporation's current circumstances. A common example would be a corporation that previously operated an active business, but now functions primarily as an investment holding company. In that situation, a December 31st year-end may align much better with the reporting information received from financial institutions. Depending on the circumstances, CRA approval may be required before the fiscal year-end can be changed. Because of this, the process should always be planned carefully and supported by appropriate documentation. Once the change is approved and implemented, the corporation begins reporting on a January 1st to December 31st basis. At that point, many of the reporting mismatches that previously existed begin to disappear. T3 slips align more naturally. T5 slips align more naturally. Brokerage reports align more naturally. and investment income tracking becomes much simpler. As a result, accountants often spend less time performing allocations, accrual calculations, and reconciliations. The reporting process becomes more efficient and, in many cases, more accurate. This brings us to what is probably the most important question in this entire section. Whenever you encounter an investment corporation, ask yourself, is there a good reason this corporation does not have a December 31st year-end? That single question can often reveal opportunities to simplify accounting, reduce compliance costs, and improve the quality of investment income reporting. The key takeaway from this slide is that changing a year-end is not simply an administrative decision. It is a strategic decision that should be evaluated carefully. For many investment holding companies, aligning the fiscal year with the calendar year can be one of the easiest and most effective ways to improve tax reporting efficiency and reduce unnecessary complexity.